Okay, we're just about 3 minutes from the top of the hour. I think we're going to get started. I know that there are people still joining, uh, but we have some ground to cover here. As you can see from the agenda, it's a packed hour. So I'll quickly say thank you for your time and get right to introducing your presenters. Jonathan Smoke is Cox Automotive's Vice President and Chief Economist. Charlie Chesbrough is Cox Automotive's Senior Economist and part of Jonathan's team. Their group tracks a wide range of business data, including proprietary information from Manheim, Auto Trader, Kelley Blue Book, DealerTrack, and others, to understand the key trends impacting both the wholesale and retail markets, as well as auto financiers. Andy Mayers is DealerTrack's Senior Director and F&I Lending Solutions Strategist. He spearheads enterprise product strategy and works with various Cox Automotive businesses to identify product opportunities that will deliver enhanced value for lenders. So Jonathan will start today's conversation with a thorough overview of the economy and the impact COVID-19 is having in general, and then particularly in auto retailing. Charlie will dive deeper into inventory levels and sales trends by brands and segment. And then Andy will round out the discussion by sharing the latest insights on how shoppers are reacting and dealers are responding to keep business flowing. We have time saved at the end for Q&A, and we encourage you to ask questions. Just type them into the questions panel at any time. And if we don't have time to answer all the questions live, we will respond to any that remain by email. And with that, it is my pleasure to turn things over to Jonathan.
Thanks, Marguerite. I'm starting first with the reminder of why we're going through all of this with the pandemic itself and COVID-19. For several months now, we've been producing a risk-based analysis on the level of risk that exists county by county across the country. And as many of you know, we went through waves. Some people call it a second wave. Some people argue it was just a continuation of the first wave, but nonetheless, we had increasing cases occurring across many parts of the country that didn't really experience as many problems earlier in the year. But the good news is that level of activity actually peaked from a daily case perspective on July 17th, and we've been seeing a declining trend in those cases pretty much consistently ever since. Hospitalizations have also been declining since the end of July. They lagged the new cases by a few weeks, and we've yet to really see deaths coming down, but based on the lag, we think that that's likely to be starting sometime soon. But the reality is we still have a peak amount of active cases in many areas of the country. In fact, every region of the country, with the exception of New England, has a red county color-coded on our map. Thankfully, when we look at this from a designated market area, or what are the major markets in the country that have risk, we're starting to see the numbers that are problematic come down. Last week, we had 18 high-risk major markets in the country. This week, we only have 12, and those 12 are concentrated in the states of Arizona, Texas, Mississippi, South Carolina, and Florida. Moving on to look at what the impact has been on the economy, we can see similar variation in impact on the unemployment that this downturn has caused. The latest data actually issued since we put the deck together that came out today, just this morning, show that 14.8 million remain on unemployment benefits, and that represents just under 10% of February's job total. As a percentage of February's jobs, when we look at it state by state, continuing claims are currently the highest in the states of Hawaii, Nevada, California, New York, and Connecticut. And those states tend to be states where travel is more significant, and/or services also play a very large role. But you can see there's quite a bit of variation state by state around the country. When we look at continuous claims in aggregate, they declined by 636,000 in the latest data from the prior week, bringing us to a 3-week decline. We've seen steady declines for 3 weeks now of 2.1 million. So after a brief pause and actually an increase in unemployment in mid-July, we've been seeing improvement since. However, in the latest data, you may have heard that initial claims increased. They increased to 1.1 million when they were below a million in the data from the prior week. That, of course, is in the wrong direction and could signal less progress in store when we get new data next week. Now, looking at consumer sentiment, when you consider the level of unemployment, consumer sentiment is very critical to follow, because usually an increase in unemployment leads to declining sentiment. And we did have a big drop in consumer sentiment when the pandemic started. And we had been seeing gains in mostly the second half of April and May. But initially, from social unrest and then turning into the COVID-19 outbreaks, we had been seeing decline. But thankfully there too, we're seeing progress over the last 2 weeks. We've seen improvement, albeit gradual, for 2 weeks in a row. The good news is not getting worse is a good place to be on consumer sentiment at this point. And then when we look at it by market around the country, we do see quite a bit of variation, and we have all throughout the pandemic. The map on the left is looking at consumer sentiment through the lens of designated market areas, but specifically measuring how it looks this week relative to where they were in February. And basically, you see that virtually every market in the country has been impacted to some degree. There are 40 markets that are in yellow, one lonely market in green that has seen a slight increase, 77 markets that are in pink that more or less are tracking what the US is seeing. And then there are 24 markets that have seen more of a severe decline. But just like we've seen in the aggregate data, we are seeing improvements at the market level. The map on the right is showing you the change in the last week, and we did see improvement because we saw more improving markets than declining markets. But 51 markets were down last week, while 76 were up and 15 were unchanged. Now, looking further into the consumer's financial health, one aspect of this downturn that has been very different from prior downturns is that we have not seen credit performance deteriorate so far. And the reason for that is really twofold, both of which having to do with what the government's actions on the stimulus helped. First of all, consumers used extra money received from the stimulus payments and enhanced unemployment benefits to pay down debts. And then consumers also benefited from loan forbearances in certain types of loans, not auto, but in mortgage and student loans specifically, and then accommodations that lenders have granted in other types of loans, like in auto. For example, Equifax estimated that through July, roughly 8% of auto loan accounts were receiving some form of accommodation. So those factors combined have helped us to see actual loan severe delinquencies decline every month, February through July. In fact, July's delinquency rates for both subprime and in aggregate were the lowest that we've seen in 15 months. But the reality is it would have been worse, and it may get worse before it gets better, with stimulus waning and accommodations starting to end. And we can somewhat see that fear of the future in some views of credit. And one of those views is just simply seeing what interest rates are doing, which we can see on the next slide. The cost of credit, or what consumers are actually seeing in their interest rates has varied by the type of loan and their credit tier. Consumer rates have not fully reflected what the Fed has been doing. When the Fed cut to zero in March, most consumers actually saw increased rates. But then rates did start to fall in April, and we generally had been seeing stable to lower rates throughout the spring and summer until we got to August. In August, we've seen treasuries move up in the financial markets, and along with that has been an increase in all types of loans, including auto and mortgage rates. And that means that spreads have widened for all types of loans as lenders are reflecting increased perception of risk. And we've seen more movement in subprime, so that subprime is, and the tier just above subprime is also now seeing higher rates than we saw in February, and rates are definitely even higher for subprime than they were a year ago. By the way, the mortgage market has looked more tempting throughout this, meaning the rates have fallen even more for mortgages than for auto, but even mortgage rates have seen increases so far in August. And of course, this influences demand. Another factor that's been influencing rates, especially in the new finance market, is what we've been seeing manufacturers offer. So the next slide is showing you the share of 0% APR loans that we've been tracking. And many of those loans, especially back in April and May, included other sweeteners like deferred payments for 6 months, the longest terms that we've really seen substantially taken in the US. Many of those loans also offered lengths of 84 months. But since April, we've been seeing the number of those loans come down. So far in August, we're at 9.6% of the loans. That's down from 12.4% in July, when in April it was 21.3%. So definitely we've seen a decline in that. And the reason for that decline is in inventory, which we'll be getting into a lot of detail when I hand the mic over to Charlie. But first, let's look at what supply is doing in the used vehicle market, because Charlie's going to cover those details in the new. Used supply was built up to substantial highs both in the wholesale market and the retail market back when the pandemic had started and when much of the country was shut down. But that supply really started to work its way down as sales recovery improved, and now we've basically in the retail market been below normal levels of supply for a couple of months now. We measure that retail supply is about 38 days today, when 45 days is normal. Wholesale supply went from being oversupplied to basically being right at normal. And when we measure it as we do in this chart in day supply, that's basically looking at adjustments for the pace of sales, which isn't fully recovered. If we simply look at absolute inventory numbers, those numbers are down dramatically and very similarly to what Charlie is going to cover on the new vehicle side. And of course, when supply is low and demand is strong, like we see, we are seeing increasing prices. And the recovery and now new record prices in both the wholesale and retail side of the business has just been astounding. What I'm showing here are average model year 2017 prices, and they're indexed to the beginning of this year, as well as the numbers from last year indexed to the beginning of last year. And you can see that wholesale more dramatically and retail both declined in the early stages of the pandemic, but we reached a bottom point and since then have been seeing steady weekly increases in those prices. So much so that as of this weekend, wholesale prices are up almost 14% from the beginning of the year, and retail prices are up almost 7% for the year. And in fact, the last couple of weeks, retail prices have been growing faster than wholesale prices. It's truly been an astounding time period, and one that, at least in the history of our data, we've never seen a comparable period to see such high values for used vehicles, especially this time of the year. And of course, that translates into at least one positive for the new vehicle market on the next slide, and that is retention rates are up substantially, and retention rates often influence what the residuals are on new lease offers, and therefore can lead to lower lease payments. So those higher used vehicle values we saw on the previous slide have directly contributed to much higher retention rates. And retention rates flipped from being 3.5 full percentage points down in mid-May to now being up 5 points at the end of July. And then looking at what we estimate has been happening on the retail side of sales in the industry, we truly have seen an impressive recovery. The chart here is using data that we estimate using a same-store methodology, looking at dealer track transactions, where we try to simulate what is actually happening in retail new and used vehicle sales. And that blue line, along with the used vehicle values I showed you, is probably the closest you're going to see to a V recovery in many parts of the economy other than the stock market. Pent-up demand, strong incentives, and available supply really helped boost sales back in May and June. Then we started to run into a little bit less consistency in July, especially for the new market first, as low inventories and reduced incentives started to limit the demand that we had been previously seeing. And now we're starting to see in August, the used market, and actually even in the second half of July, the used market started to be less consistent as well. And as I showed you, there's no question that inventory is starting to become a problem in the used vehicle market too. So that basically sets us up to, go back to some of the earlier data that we were looking at that showed differences around the country. Have there been differences in this recovery by market? And my final slide is basically showing you what we've been measuring using unique credit application submissions from DealerTrack, but looking at it by week, comparing to the same week last year in every DMA in the country. And we have seen quite a contrast, and there's no question that the map this week looks far better than it did at the beginning of April. That April 5th map on the left only had 7 green markets, and green was the code we used for not looking like they were impacted by the pandemic. There were 39 red markets back then, and those dark red ones were down 95% year over year or more. When you compare that to what we saw last week on the map on the right, no market was down more than 55% year over year last week, so no markets quite made it to the color red. And we have far more green markets. The map has 91 green markets. Collectively, those markets were down 2% last week compared to the same week last year. And the 116 yellow markets were down on average by 18%. But if you were looking at these week by week, you would have seen that the map was most green and most attractive back in June, when we had 80% of the markets in the country, or just about that number, up on a year over year basis in sales. Now we're only seeing about 20% of the markets up. And basically what we're seeing is more consistency in terms of the performance. And we've definitely lost momentum, or certainly the strength of the momentum we had back in June. So with that, I'll hand off to my colleague, Charlie Chesbrough, to go over more details about what we see in the new vehicle market.
All right. Well, thank you, Jonathan. And yeah, just as you were saying, you've seen some historic numbers in the used market. We're certainly seeing some historic activity on the new side as well. Let's start by reviewing what's happened so far this year. On the left, this is showing the light vehicle monthly sales SAR, the seasonally adjusted monthly selling rate. And you can see in blue there that over prior to the COVID outbreak, we were humming along at a nice 17 million pace pretty consistently through 2018 and into 2019. And then this pandemic hit and we hit a historic low in the month of April. The SAR in the month of April hit 8.7 million. We've never hit that record low at any point, at least going back to the mid 1970s, when the month, as far back as the monthly SAR data goes. And even in the worst of the Great Recession, we didn't hit that seasonally adjusted pace. But we've improved since then, and we did see gains in the month of May and June, although it's been a slow recovery. And then we saw July, which really actually I think surprised quite a few folks on the upside. We were only down 12% in July, and that's from hitting a low of being down close to 46% in the month of April. So we have seen a nice recovery here. The question we're wrestling with as forecasters is, where do we go from here? There was a lot of support to force this V-shaped recovery to happen. One of the things Jonathan showed you a few slides back was that large spike we saw in 0% financing. Well, that spike has passed. You know, the manufacturers went aggressive on the incentives, on the rate subventions in late March, throughout the month of April. But many of the OEMs have backed off of those offers now. They don't need to be quite as aggressive, given that inventory levels have fallen significantly. And so, did we pull ahead some demand? You know, did we bring people into the market that may not have been there otherwise, simply because it was such a good offer? 0 for 84 was something relatively new. I don't think we've seen something like that here in the US market, at least not on popular vehicles. So it's been a very volatile market. Our expectation is that this volatility is likely to continue throughout the rest of this year. It's hard to really see that this V-shaped recovery is going to continue uninterrupted all the way through to January. And part of the reason for that is that, as Jonathan was talking about some of the stimulus activity, we're a long way away from that stimulus that came out a few months ago. We have built in an assumption that we think that the federal government is going to have another stimulus offering here in the next few weeks. But boy, if they can't come to some sort of agreement, we may have to alter our year-end expectations. But at this point, we're expecting the market to finish somewhere around 13.6 million vehicles this year, down about 20% from where we were last year, but certainly an improvement over where we were just a couple of months ago. And as we can see on the next slide, though, the impact on the different manufacturers has been quite varied. Overall, we've been down about 22% year to date, but you can see that some of the brands are down significantly more and others are down significantly less. There's a lot of moving parts that's going on behind the scenes in these numbers, some of which is under the manufacturer's control, but a lot of it was not under their control. But certainly some of the mitigating factors in terms of year-to-date performance, who are big players in the fleet market. Certainly we know that Nissan and Fiat and Dodge all engage in quite a bit of fleet activity. We know there's been a huge pullback in rental activity because of the huge hit that the travel industry has taken. Business travel, I think, is down near to close to zero at this point for most firms. That's had a huge impact on fleet activity. And so that means some manufacturers that engage in that have been hit particularly hard. And thus those that don't have not been hit quite as hard. And that's where you can see firms like Lexus or Lincoln, they don't do a lot of fleet activity. So they've actually held up pretty well. The other factors that's involved in this is sort of what's your basis? How good a year were you having last year versus this year? Firms like Kia and Hyundai released some new products at the end of last year, which have actually been selling quite well. That's helping to make their sales look fairly strong. And of course, Tesla there on the far end, they're a little bit of an oddball. They may not have been hit as hard in this pandemic, in large part because they don't have a direct-to-consumer, or they have a direct-to-consumer business model. So when governors shut down economic activity around the country, they may not have been hit quite as hard. So we look on the next slide, though, we can see what a result has been of all of this. The changes in market share have been substantial. Manufacturers have been gaining and losing quite a bit in a very short amount of time here in the first half of this year. Again, we can't hold these guys too accountable for the losses that they may have suffered or the gains because there have been a lot of moving parts out of their control. But certainly there's ramifications from having the sales rates that we saw on the previous slide. Nissan appears to be the early loser, if we can say, in the first half of this year. They've lost a significant amount of market share. Certainly their fleet activity as well as some aging product is probably holding them back. And as I said earlier, Kia and Hyundai have got some new products that's helping them gain some market share. And we know Chevrolet did some very aggressive financing offers on a lot of their pickup trucks early in the pandemic. That seems to have been fairly successful, at least in terms of moving the metal, and that's allowed them to gain some share. So it's really been quite volatile out there through the first half of this year. Winners, losers, product introductions probably delayed, product sell downs delayed, and I'll show you a few more slides on that in just a moment. But it's really been volatile, and a lot of it's been because the states all reacted differently when the worst of this pandemic hit. And as we can see, looking at this slide, what I did is I did an analysis of looking at the year-over-year change in different states around the country between March 1st and April 30th, sort of the worst period of this pandemic. And what we see here, and this is all retail data, so there's no fleet in here, we see that over those 2 months, national sales fell about 45%. But you can see probably the big loser in this environment was Pennsylvania. Their sales fell 72% on a year-over-year basis for these 2 months. And you can see New York down 63% and California down 56%. These are very, very large markets, so that's a huge hit to the industry. And what we know is that governors in those states, and particularly in Pennsylvania, they shut down early. They shut down business activity. Dealers couldn't even sell a vehicle if someone was at your front door knocking on the glass. Many of these states were just forced to close all retail activity entirely, at least for a certain period of time until they started to slowly open up. In the middle there, you have Texas. They were down 31% during this period. And the winners, if we can call them that, appear to be Arkansas, Oklahoma, South Dakota. Arkansas was only down 12%. Their governor never did shut down the state during this time period. So if you had to get an idea of how much of the losses were due to government policy in terms of governors forcing the end of retail activity, and how much of it was maybe consumers just pulling back because they were fearful of the virus, well, Pennsylvania and Arkansas may give you a ballpark idea as sort of the extremes as to what those different activities may have had on vehicle sales. But if we look at what's really interesting, looking at the next slide, is that we know that these changes didn't last very long. And that Pennsylvania, and that market share losses were significant during this time period, but these shares didn't stay this way for long. Pennsylvania lost 2.2% market share, New York 2.1%, California 2.0% market share. These are big changes in just a very, very short amount of time. Florida appeared to gain that activity, and Texas, of course, appears to be the big winner. In large part, the activity that we're seeing here in this slide is that the southern states and many of the Midwest states, they didn't shut down, while we know on the East Coast and on the West Coast, many of those markets did. And so this did allow them to gain quite a bit of share from other parts of the country. In Texas in particular, we know it's a big pickup truck market. Many of the aggressive financing offers that we saw in late March and early April were specifically targeted towards the pickup trucks. And so that really benefited much of the share gain that we saw in Texas, because that was really quite a successful program in terms of boosting sales. But this was all temporary. If we look at the marketplace in sort of post the worst of this crisis on the next slide, we can see that these market share changes were only temporary. And if we look at the periods of comparing March 1st to April 30th to sort of the immediate recovery period of May 1st to June 15th, we can see these market share gains that happened in the prior period are quickly lost in the next period. Pennsylvania's market share rose 2.1% in this early recovery period. California, New York, both saw their market shares rise. And at whose expense? Well, both Texas and Florida started to see their shares now decline. This is all sort of these moving parts that we saw, where governors started to impose restrictions on some of the central and southern states, while governors in the East Coast and the West had lifted restrictions, allowing markets to open up again. And so consumers flowed back into the marketplace. So it's a bit difficult to really try and gauge the success of the market on an individual manufacturer's basis, or even at a state basis so far this year, because there have been so many moving parts. But as we see on the next slide, just looking at retail sales for the different states year to date, there are some winners and losers here. We can see that New Mexico appears to be sort of the big loser thus far, down about 35% year to date. It's a fairly small volume market, so that's not really that detrimental to vehicle sales. But there is a general trend that kind of emerges from here, and that is the large early shutdown states in general, like your New York, your Pennsylvania, your Massachusetts, California. These states have suffered significantly more than the states that did not shut down, like we can see in on the far right here, like South Dakota, Oklahoma, Montana. These states, again, small volume states, but they have not had the same kind of response. And I think much of this can be attributed to the government actions. So a lot of moving parts out there. Again, I would just suggest that it's going to be volatile throughout the remainder of this year. So be prepared for multiple strategies going forward, because I think there's really is a chance that we could see the recovery continue from here, or we could start to see the recovery start to abate a little bit, because there are some significant headwinds out there. So if we go to the next slide, we can start talking about what might be going on in the marketplace. And I think this slide is kind of helpful to kind of understand what might be some of the forces that are working in the marketplace today. I've got a grid here where I have different brands and what their average transaction prices are there on the x-axis. And then I've also overlaid this with what we've identified in our dealer track data. What is the average interest rate that buyers of that brand are contracting for? And the idea here is that we think that in an environment where we have such a significant recession, that consumers are going to be seeking value. They're going to be seeking lower prices. So there's this pressure coming from the right on high-priced products like Porsche and Land Rover. And even within brands that have lower priced portfolios, their higher priced products may be under threat, because consumers are not seeking ways to live large. They're starting to think of ways to batten down the hatches, to try and be a little bit more frugal with their spending. So these value issues are going to be going on in the marketplace, and it's going to change the perceptions of consumers of different brands and what their desires are going to be in the market. But we also have the issue of credit availability, which is being measured on the y-axis here. And what we have here is the average purchase interest rate, and I'm using that as a proxy measure of FICO score, that the higher interest rate that you're contracting to probably suggests that you've got a fairly low FICO score. If you've got a low interest rate, it probably means you've got a pretty good FICO score. And where I think this is useful is it helps us identify who are the customers that are buying these products. And what jumps out at us here is we can see that Mitsubishi, their customers are paying some of the highest interest rates in the industry. This would suggest that their natural customer base has a fairly low FICO score, certainly relative to some of their competitors out there. These customers may be under threat in this environment. The lenders out there may be a little bit more reserved in terms of their desire to lend to these types of customers. Certainly there's going to be a flight to better quality, to lower risk, and everyone's going to want that 800 FICO score customer in a recessionary environment. The demand for lower FICO score customers may become more challenged if this recession gets significantly worse here in the fall. And in addition, it may be that these folks that are paying these high interest rates, these are probably your hourly workers, or in many ways, the folks who are on the front lines of the job losses of the recession that we've had so far. Hourly workers, retail, travel industry, these folks got hit very, very hard with the job losses. It has not been quite nearly as significantly job losses for the high incomes folks, the 6 figures plus. And so it may be that even though we have low priced brands out there, low priced products, they may not sell particularly well simply because their customers have been hit particularly hard. And in fact, if we go to the next slide, that kind of is illustrated here. It's really just the same analysis, but looking at different types of products. And we can see that the luxury vehicles, the high-end performance vehicles, very high-priced products, maybe aspirational, not something that I have to buy, more of a like to buy. Those vehicles may be under threat in this environment. But at the other end of the spectrum, you can see subcompact car, compact car. These are some of the lowest priced products that we have in the new vehicle market, and yet sales would suggest that they're not performing that well year to date, which seems a little bit counterintuitive. But I think this is what we're seeing here, is that these high interest rates are reflecting the types of consumers that are buying these products. And as I said before, my guess is that subcompact car buyers and compact car buyers have been hit hard by the job losses, and so they may have been forced to pull out of the new market, and in fact may now be in the used market. So let's talk a little bit about what we're seeing regarding sort of the next headwind that we see for the industry. This is a slide similar to what Jonathan showed you a few slides back, looking at new and used vehicle sales. But this is slightly different in that it's a rolling 30-day vehicle sales. It's a weekly total. And we can see, I think, some interesting trends that emerge from here. In light blue is the used market. You can see there is a nice V-shaped recovery, although it has started to moderate here over the last few weeks. And in the new market, in the darker blue, you can see that we have a similar V-shaped recovery, but the vehicle sales are now starting to settle in, but at a lower pace, down somewhere in the neighborhood of 8, 9, 10% from where we were last year. These trends have really created some very volatile situations regarding inventory levels at dealerships around the country. As we can see on the next slide, that the available inventory has been changing dramatically because we've seen vehicle sales come back fairly well while the actual supply of vehicles has been constrained. And what's particularly interesting about the situation that we're in right now in the industry is that normally in a recession, some sort of recession hits like we had back in 2008, demand pulls back significantly as folks are shocked, job losses start to happen, they pull back from the marketplace. Usually the manufacturers keep those factories going though, and that we keep building up inventories even though demand has fallen off, and we end up in a situation where there's too much product out there and we have to increase incentives significantly in order to clear out our excess inventory. But this time around, the pandemic hit both supply and demand. That even though demand had fallen, supply had fallen as well because the factories shut down around the country from March and into April. Even today, we're hearing a lot of anecdotal stories of, even though the factories are running, they're running slow and they're having to shut down. And we're hearing stories of some manufacturers with outbreaks on the assembly line, and they have to shut down temporarily for either a day or a few hours. And of course, within the supply base, those making the parts that go into the assembled vehicles, we're hearing a lot of stories about different manufacturers around the country that are falling behind and having labor shortage issues in terms of trying to keep their own little parts factories going. All of this is creating an environment where you can see that available supply has fallen significantly. What we track is sort of the days of supply, that based on recent sales activity, how long is that existing supply that you have going to last? And you can see on the right here that days supply really spiked. Oh, I'm sorry, still working on it. There we go. The days supply really spiked during the worst of, nope, other slide. We can go back. Days supply really spiked during the worst of the virus, but has since come down. And now we're hovering close to about 60 days of supply. That's below where we were last year. And the concern is that if we don't see these factories really get up and running quickly, we're going to see supply levels really get challenged, and it's probably going to start to constrain sales. So we can go on to the next slide now. The other interesting thing that's going on is that the model year rollover, which generally happens in the months of August and September, is way behind schedule. What I'm showing you here is the dark lines are what we have this year, and then in the dotted lines are the situation that we had the same week last year. And so in orange, this is the prior model year's inventory. What share of inventory is the prior model year? You can see that we've got a few more of the model year 2018s or 19s this year than we had 2018s last year. And what we can also see is that the next model year, the model year 2021s, nowhere near the level of model year 20s that we had last year. At this point, we had about 11% of inventory was model year 2020. This year, it's only 2% is model year 2021. So the rollover's way behind schedule. I think this means that folks may be in for a bit of surprise if they come to showrooms this fall and are looking to see a whole bunch of model year 2020s. And just going to the next slide, because I know we're running a little bit long. We can look at the inventory levels for different manufacturers, and it really varies across manufacturers, but we know that Subaru and Toyota are particularly in a very tight inventory situation. They have below 40 days supply. Fiat and Mitsubishi, they're at the other end of the spectrum. They have quite a bit. And then just looking at the next slide is what share of their inventory is the prior model year, and back previous slide. What share of their model year is the prior inventory, and then the next inventory. You can see only a few brands even have model year 2021s out there just yet. The Kia Solstice and I think the Chevy Trailblazer are two of the vehicles that are out there. But a lot of manufacturers haven't even released those new products yet. And then we can go on to the next slide, just looking at the luxury market. It's a very similar situation in that just a couple manufacturers in a very tight situation. Both Lexus and BMW appear to have a very tight inventory situation, while Buick and Lincoln are leading the pack, or at least have much more inventory than their counterparts. And the other interesting thing we can see here is that none of these luxury manufacturers have any 2021s out there in the marketplace just yet. Our assumption is we're going to start to see these really start to hit dealerships over the next few weeks. We should see these numbers start to improve. But again, the whole pandemic situation has really left us behind schedule, and this may help the recovery here over the next few weeks. And just to finish up talking about what we're expecting for the year, I won't go through all of these numbers, but really the big one is, as I said before, we're expecting new vehicle sales to finish down about 20% at 13.6 million. The big question is can the recovery continue on its pace for this year, or does the shortage of inventory, the lack of government stimulus, do all of these things sort of hiccup the recovery? And I think at this point, we just got to keep our fingers crossed and hope that sales and consumers continue to come back to the market. And with that, I'll hand it off to Andy Mayer to hear a little bit about what we're hearing from consumers and dealers.
Yeah, thanks, Charlie. That was really a lot of insights. And just so everybody knows, we will be sending out the deck afterwards, so you'll have that. I know there's some questions. Hope everybody's doing well. I just want to take the next few minutes and kind of just talk about what we are hearing and seeing from our dealers and consumers, and basically how this is translating to auto finance. We at Cox have a research team that on a bi-weekly basis surveys consumers. We've been doing it since March, as you can see, to understand the COVID impact to them. Generally, our surveys have reached over 1,000 consumers, nationwide sample, and over 650 dealers. So just to kind of give you some feedback and data from them. First of all, let's talk about dealers and when we think we're getting back to normalcy. And define normal would be another whole conversation we can have one day. But you can see basically franchise dealers and independent dealers a little more optimistic about when we're getting back to normal. About 39% think that we'll be back to normal shortly, where franchise dealers are a little more reserved in that. And you can see it actually went up and down in the case of franchise dealers, which I think kind of reflects some of the regional values we have. More importantly, on the right-hand side is consumers' thoughts about when getting back to normal. You know, this has improved actually, as obviously we've gone through the numerous phases. You know, shelter in place for all of us immediately did not have a sense of normalcy. So we didn't exactly know when we would be getting back to normal. But now we're up to about 48% of the people think by 2021 we'll be back to normalcy again. And it's grown, I think, as people have adapted and gotten used to what the new normal is. So we can go to the next slide. I'm not going to spend a lot of time on this. I do want to get to another slide to tie back something, Charlie. We're actually tracking by income bracket how people are affected. And you can see, obviously, the impact of COVID on employment has improved, if you can use that, for the less than 35,000 income, and it's been relatively stable. The next slide, I think, is important based on what Charlie was saying, if you talk to that. This is really when we surveyed all of our customers and consumers, how they're affected by salary band. And this ties directly with what Charlie was saying about you know, the income product of the income of our consumers and the buying habits. You know, as expected in the lower income bands between 35K and 35 to 75K, we've seen a higher level of laid off employees, unfortunately. I think directly related, as Charlie's saying, to travel, business, services, and things like that. Unfortunately, also, you're seeing the effect of small businesses. You know, 6%, the employer just simply went out of business. So the higher income consumers that we surveyed, the biggest issue they've had is relative compared to someone who's laid off or out of business, but has been salary and pay cuts. And you can see the furloughs is kind of consistent across. But I think this is really important for us from a financing perspective, because this helps understand where our customers are going to be in their ability to pay and their ability to purchase when they go forward. If we go to the next slide, please. This we've been tracking since the early March, and I think it's a really important thing for everybody to understand. What is the impact of COVID on someone's intent to buy a vehicle, right? So when we started out our first surveys a long time ago, March, 32% of the people weren't sure when they would be buying a car. And depending on how it's tracked across the nation, you saw some recovery in those numbers. It, you know, went from 32, not sure, down to 13. It's bubbling back up to 23%. Some of the factors on that are financial uncertainty, ongoing COVID cases, the need for a car. Fewer miles are being traveled. Do people really need a second car or a new car at this point? We've also heard some concerns about civil unrest and the ability and impact to them, and then general uncertainty in the marketplace are some of the drivers. But ultimately, 55% of those delaying purchases are still concerned because it's an uncertain time for them to buy a vehicle. And I think the big takeaways here is the delay in purchases has improved. We're back to about 29%, but it's still, you know, not higher than where it was pre-COVID. We go to the next slide, please. Let's talk about how people want to buy, you know, and where they want to buy. So, you know, 17% of the people back in the early outbreaks were not looking to buy a vehicle. It went up a little bit in March and April, stimulus checks, things like that. We've seen a slight trend downward since June through August. We're back down to about 26% of people that are looking to buy vehicles in the next 6 months. But unfortunately, 38%, only 38% are not delaying because they think it's a good time to buy a vehicle. So there's still some apprehension in the market about buying vehicles. I think what we're going to see with the inventory availability, prices are going to go up, and it's going to be a challenging time in the next couple months from a consumer's perspective. If we can go to the next slide, we really want to talk about the major thing we've seen, and that's really online shopping. Pre-COVID, online shopping was, a nice to have, and it's how things were being done. Now with COVID, online shopping is how people want to buy things. 85% of the shoppers are more likely to buy a car from a dealer that allows them to complete all the steps or steps of the process online. Consumers want to do things from home. They want to socially distance. On a positive note, I think as we've opened up, we've seen a little bit less apprehension when it comes to the customers that still want to do things online. 56% of our customers still want to do things online. It's come down a little bit since 63%. So there's a little bit of openness going in. We've also seen in the research that luxury shoppers are the highest segment of customers who are less likely to visit a dealership in person. I think you've even seen that in the advertising from the OEMs, a lot less of the contactless delivery is some of the things we're seeing. Continuing on the online trends, if we go to the next slide, what we're really seeing is the dealers are benefiting from doing digital transactions. About 71% of our dealers are seeing more customers complete more things online. And that's happening both in franchise and independent space. And then from a buyer's perspective, they're just getting a better experience. It's funny to say that 39% of the people thought their experience was better than the last time. Now we're up to 52% of people who actually bought a car since mid-March thought that the buying experience was actually better. And if you think about it, it's a more challenging time for test drives and information, but somehow they felt that experience was better. And we've seen that. If you go to the next slide, you will actually see one of the benefits that we've seen. And let's talk about what they're seeing, which is removing friction from the financing process. A lot of consumers we surveyed, the ability to do an application online has been more beneficial. And now, as we've seen a tremendous emergence in our industry with remote deliveries, remote signing, basically what we've seen is that the customers are much more engaged online. They feel more comfortable with social distancing. Digital contracting we have seen has grown significantly. We've had a 94% increase in interest from dealers and a 97% increase in remote signed contracts, keeping in mind that we just, as an industry, really started launching remote signing back in March. I can tell you that over 5% of the transactions that are being processed right now are remote signed, meaning a consumer is not signing in the same location as a dealer from what we're seeing in our platform. So these are some of the trends that are happening. I think as we talk about this as an industry in the auto finance industry, from you as a lending partner, being in a position to support, which most of you have been, very rapidly supporting remote signing and digital contracting, accepting online credit applications, finding ways to facilitate your dealer customers and your consumers who aren't walking into a dealership. I would say that this emerging trend has still led to some concerns from our lenders' perspective about fraud and compliance and ensuring that the processes maintain compliance in the flow of processing a customer online. If we go to the next slide, I just want to talk about some of the things that we should be considering as a lender. It's been a challenge for our lending institutions. If you look at all the spikes that Jonathan and Charlie showed, it's really hard to provide consistent level of service when your volume is going up and down. And early on in this pandemic, we had some challenges even, with the number of resources we had available, readjusting for everybody, working from home and things like that. So, our dealers have seen the pain of some of the service organizations that have been a challenge. It's due to the velocity. So the conversations we're having with our lenders are all about automation and efficiency. How do I improve my online transactions? How do I deliver additional value to my dealers through things like alternative deal structuring, or even providing structured STIPs? Eliminating the need for a rehash between a dealer and a lender have become very important. And most importantly, I think as an industry, making things as automated as possible, and digital contracting is one of those things. Eliminating paper from the process has saved a lot of time and effort for our lenders. But I would also say some of the challenges that we're also having is tighter lending guidelines. You know, as Charlie mentioned, as Jonathan showed with the rates going up, it's been much harder for our dealers when we talk to them to figure out how accurate the pricing is going to be on a deal with the risk-based pricing that's going on. There's been a lot more STIPs. There's been a lot more conditions, and things are not as easy for dealers to spot deals as they were in the past. So as we can figure out ways to help them from an efficiency perspective, provide them more opportunities to understand how to structure deals efficiently, these are some of the things that our dealers are asking for. And then I think the last thing we all have to be cognizant of, which I thought was very interesting, is when you looked at Jonathan's chart of delinquencies being down, but the reality is that just a matter of payment deferrals and things like that. So how are we positioned organizationally? How are we positioned industry-wide for collateral risk mitigation? How are we putting the right valuation tools to ensure you're maximizing your collateral investment? So it's really important as we think not only at the origination part, but we think of the tail end and the servicing, that we talk about that as well. In the spirit of time, I just want to go back and we'll switch over to questions now. So Marguerite, if we want to go to the next slide, and maybe we can just, I know we're running up against it, but I think there's a few questions out there, and maybe we can ask the team to answer some of those.
Absolutely. So the first question that we have is, if a second stimulus check is not issued, how do you predict market conditions may change?
I'll take that. I think Charlie mentioned specifically that our baseline forecast is assuming a new round of stimulus, and in fact, we're assuming it'll be about 1.5 trillion happening in September. If it doesn't happen, we're likely to see the economic recovery stall or potentially even contract in the remainder of the third quarter and fourth quarter because of the high level of unemployment. Basically, we have a little less than 15 million on traditional unemployment benefits, and then we have even more than that are contract workers and such that don't qualify for those traditional benefits, but are certainly have an impact to income. And so as a result, we've got a lot more people at risk, and certainly more than we've had at any point so far in this pandemic. So it's really an important factor on exactly how the next several months is going to play out.
Great, thank you, Jonathan. Next question, are there additional insights you can share into the health of the independent dealer sector?
Well, there's a couple of different ways to look at independence relative to the overall market. Let me refer to surveys that we do. We do a dealer sentiment index, and we have the ability to break out what franchises look like relative to independents. And we saw a stark contrast between franchise and independents in the second quarter. Independents as a group were more negative, and were specifically also more negative about the outlook because franchises remained optimistic, and we didn't see that optimism in the independents. The majority of independents actually said their top priority was staying in business, and that contrasted with franchises far more likely to say they're focusing on gaining market share, improving efficiency, improving the customer experience. So there was a real difference. And we know this has been a tough environment for independents, principally, I would say, related to credit and inventory. I think it's been well publicized that some lenders stopped serving independents, both in terms of floor planning or dramatically curtailing floor planning, as well as providing lending for their consumers. And likewise, this has been a difficult inventory environment when independents are more likely to rely on auctions, and that's where we've seen the declining supply and where we've seen prices run up dramatically. So it's definitely been an even worse environment for independents than franchises. And I would also add that the traditional independent is having to deal with the new form independents like Vroom and Carvana, whose basic business model was tailor-made for this situation of being digital only. And so those things all combined definitely speak to the health of the independent being more challenged than the franchise.
Thanks, Jonathan. Team, this is a bit of a long tail question, so let me read through it. Recent stats show 43% of the US population is subprime, under 660 FICO. Hourly workers comprise 77% of that total. As the shelter in place continues, can you speculate on the impact of subprime lending and portfolio performance? That's the first question. If subprime declines, how does that impact your sales forecast? Part 2. And part 3, do we face potential capital issues reminiscent of 2008, 2009?
Well, I can start, and Charlie, you can certainly jump in, and I don't mean to dominate the questions here. But subprime is clearly the most vulnerable. I think Charlie's information shared that, the delinquency chart I showed actually showed that subprime was having delinquency issues prior to the pandemic. And we know that disproportionately those subprime borrowers are more likely to have been impacted by the job loss or income reduction. If there is good news, as I shared, specifically lenders have already tightened. Rates are higher, not lower for subprime borrowers, and their share has already dropped substantially. So I think this is more about loan performance than it is about demand, because I think demand is already being impacted by those who are subprime and more vulnerable. And the subprime has lost share, by the way, in both new and used so far in this pandemic. But given reserves already taken on expected loan deterioration, and I'm basically just looking at that through the lens of publicly traded companies who have shared what they have done, I think lenders and investors are prepared, and higher values, of course, help to diminish the losses.
Great, thanks, Jonathan. I know we have a bunch of questions in and we're at the hour, but we'll take a few more if people want to hang on to the webinar. Next question, you mentioned that some of the manufacturers have seen gains in units sold based on new products. Are these products new models entering the market or retention products like the Hyundai Assurance Program?
Boy, well, that's tough to say. I mean, I can't, we don't have any data on sort of which particular program is driving the market, but certainly, a lot of it's just sort of who's got new product, who's got old product. We can see that having an impact in the marketplace, that, those new products that are coming out, certainly Hyundai and Kia have got these new SUVs that have been doing quite well.
Yeah.
New product on the shelf is always of interest to consumers. And that's why this sort of delay I was talking about with the model year rollover could be just another hiccup that we're looking at in the recovery, because a lot of folks come to the market in the fall knowing that that's when the new products are released. And if they're not there, are they going to buy what is, or are they just going to wait? It's just one more obstacle that we've got to get through.
Yeah, it's an excellent question, Charlie. And what we've been talking about from a quote unquote product perspective, we've been literally talking about the automobile product. And in the case, you bring up a very interesting example with Hyundai, because Hyundai has their insurance program, which is a financial product, as well as a highly sought after SUV product in the Palisade. And so I think some of the performance, Hyundai's been one of the stronger performers that has been a winner in this marketplace. You could potentially attribute it to both, physical product and financial product.
Great, thank you both. Another quick question in regards to the segment vulnerability grid, slide 22. Is this data based on 2019 or 2020?
I'm sorry, I missed that. What was that again?
It's your grid, Charlie. You're using 2019
that's 2019
data, right?
That's 2019 data.
Yeah.
Calendar year.
Great. You know what, we'll do one more question because we are over time and I want to be mindful of everybody's schedule. What is the percentage of lenders you see using paperless remote fundings, and what are the potential risks they have reported and safeguards they have in place to prevent fraud?
I think I should probably take that one. In terms of percentages, I would say a majority of our lenders have signed off on the ability for their dealers to do remote signing. I think that the reality is that the safeguards they have in place are the burden of their dealers, and their dealers have the responsibility of know your customer. Tools like ours ensure that the customer is verified. They run red flags, out of wallet checks prior to signing contracts. There's also safeguards in place for remote deliveries to make sure that when the customer has the vehicle actually delivered, in the case of a remote delivery, they sign an additional document which confirms the identity of the person who's been verified, and also and allows the consumer to verify that they were given the installment contract and things like that. So there are controls in place, but percentage of lenders, I think, is relatively high. The one thing I would say is that most of our lending partners have been very, very cognizant of ensuring that the creation of a securitized contract is maintained, that the signing ceremony is executed with a way the customer can do consent electronically. The consumer gets a review copy prior to signing. So some of the standards that are required for a successful e-contract are highest priority for our lending partners.
Great, thanks, Andy. We're at 3:05. I want to thank everybody for staying on even 5 minutes after the webinar was officially to end. We will answer all of the remaining questions, and thank you everyone for sending those in. We'll answer them via email. But if you have any questions or you want to reach out directly to our chief economist, our senior economist, or our strategist, Jonathan, Charlie, or Andrew, their emails are right there. You can follow Jonathan on Twitter as well. I want to give everybody the opportunity to say thank you to you, and we will make this recording available probably within the week. And when you close out, you will see a quick 4-question survey as well. You might also get it in your thank you email. If you could just let us know how valuable you found this time, we'd appreciate it, because it helps us build better webinars for you each time we offer them. So let me hand this over and give everybody an opportunity to say thank you to you all.
Yes, thank you.
Thanks, everybody. Be well.
Great, thank you. With that, we will end the presentation. Thank you, everyone.